Namaskar, this is Akhilesh Bhargava. Welcome to Tit-Bits on Business and Finance with me. India's stock markets have been booming. The Nifty and the Sensex continue to scale new heights week after week. But this surge in the indices has not been fueled because of corporate profits looking up or because of India's real economy looking far better than what it was. The surge is not because corporates have now become much healthier than what they were. It is actually a surge because of too much liquidity in the stock markets. Too much money has been pumped in and it is chasing stocks, it is chasing goods which are lower in number relatively, and that's the reason why the prices are going up. The prices are not a reflection of the state of corporate profits in India, because if they were a reflection of the state of corporate profits, then the stock market indices would not be booming. Let's look at the state of corporate profits in India. Corporate profits have gone up in quarter 2 of this financial year, which is the quarter ended September 30, and that's happened after a year-long slump. Two reports have recently come out by way of analysis of corporate profits in this quarter, which is the September quarter, one by the RBI and the other by Capitaline. The Capitaline report is based on analysis of profits of 1,774 listed publicly traded companies. But then these companies did not include banks, financial services and oil and gas because of the typical way of reporting of their profits. Others were included. And this study says that as against corporate profits falling by 67.3% in quarter 1, which is the June quarter, in quarter 2, there was a recovery of sorts. In quarter 2, corporate profit recorded a growth of 1.42% on a year-to-year basis. Net profit of all these companies which are studied by Capitaline went up to 8.7%. It was 5.63% in the same period last year. Thus, on a year-to-year basis, September quarter witnessed corporate profits improving, looking up. The point to note here is that while profits have gone up, sales and revenue continue to remain in negative territory as far as the growth rates are concerned. Profits have gone up in this quarter because of various reasons. The prime reason is cost cutting. Cost cutting took place because corporates retrenched staff. They engaged a lower number of people. They also cut down travel costs. After all, travel was not taking place. Rental costs also went down. Advertisement, promotion costs also went down because new products had not really been launched. And because of work from home scenario, the corporates saved money on account of establishment and administrative expenses. Because of this, even the cash flow of corporates looked up, it was better. The cash flow of corporates looked up primarily because of better profits, cost cutting that took place, no capex. Corporates have not been spending anything on capital expenditure. Incidentally, they also had better price realizations in this particular quarter, and RBI study says that these companies have sold assets such that they have liquidated their loans, they have liquidated their liabilities, and their cash flows improved because of lower interest now being paid. Thus, in this quarter, profits looked up, cash flow also became better. Sales went up in this quarter because of what newspapers now say there has been a pandemic fatigue. The pandemic has now tired out people and they have been shopping. Sales also went up because of restocking of inventory by businesses, because of festival demand, because of the lockdown demand as we call it. But then, despite sales going up, their growth remains in negative territory. In quarter 1, the growth rate in sales was minus 28.3%. That's the kind of slump that took place in sales in quarter 1. In quarter 2 also, the growth rate in sales was in negative territory, 0.75% contraction of sales in quarter 2. Experts say that quarter 3 should be much better. We might beg to differ, but the present perception is that because quarter 2 went good, quarter 3 should maintain that kind of momentum. That was the Capitaline study on corporate profits in quarter 2 of this financial year. Let's look at what the Reserve Bank says. The Reserve Bank studied the corporate results of non-financial listed companies and they were quite a number that it studied because they constituted 4/5 of the market capitalization of those respective companies. The RBI study also says that there was a sharp increase in sales, there was a sharp increase in profits in this particular quarter. And the RBI says and agrees that that happened because of cost crushing asset sales in order to repay liabilities. And because of that, the overall impact was that cash on hand of corporates has gone up. The Reserve Bank expects quarter 3 also to be in a similar momentum, to be in a similar territory, such that there will be positive growth in sales and positive growth in profitability of companies. The Reserve Bank's estimate now is that quarter 3 is not going to witness a contraction of the economy. And if that happens, of course, there would not be contraction of corporate sales and profits also. So if you go by the RBI estimates, perhaps quarter 3 might see momentum of sales and profits for the corporates. But then the reality is that even if a sales momentum, a demand momentum is maintained in quarter 3, which is the quarter to end on 31st December, yet it is very clear that profits are not going to keep pace. And that's because there are very bright chances that the staff that was retrenched, because of which costs were cut, is going to be re-employed by corporates. They will not be able to maintain growth in sales and production with the existing depleted staff that they have. Raw material costs are expected to go up because inflation is rising. And those costs which have been pruned because of closure, which is rentals, advertising, promotion, etc., will also go up. Therefore, even if Q3 sees a better sales momentum going on, profits are not expected to keep pace. Moreover, there are many other challenges for corporates. The first challenge is to now restore their position of sales and profits, at least to come back to what it was in the financial year 1920. Financial year 2021 is certainly expected to see a huge loss in output that needs to be regained. That needs to be regained, and the position of financial year 1920 has also got to be restored. And then the COVID resurge is one sword that keeps hanging on them. Therefore, sales may go up, perhaps, but then there are challenges. There are challenges of COVID coming back. There are challenges of output being restored. There are challenges of a debt overhang on the corporates. And the biggest challenge that remains is if revenues do not keep pace, in that case, there is going to be a debt default. Corporates are not going to be able to service the debt. The fact of the matter is that if corporates are witnessing a contraction in this financial year, the economy is expected to see a contraction of 10% in this financial year, then even if the economy and the corporates grow by 10% in the next financial year, you are just maintaining the position as it was for financial year 1920. It does not represent any accretion of growth. This is the reality which is there. And while we talk about a quarter to quarter situation, we think that we need to talk about what is going to be the long-term situation for corporates. We need to get away from a quarter to quarter position and see the long-term trajectory of corporate profits, corporate growth. The fact of the matter is that when we talk long-term, then the factors in play are entirely different. India's corporates will see a long-term growth in profits and sales only if the capital expenditure cycle is restored. Corporates will need to invest. Corporates will need to invest in new projects, new capacities, new technologies, all of which is stagnant at the moment. A study very clearly says that since 2015, gross capital formation in India has been on a negative trajectory and it continues to decline such that at the moment it is completely in a negative territory. Output of capital goods has contracted just as the economy has contracted, and that means new capacity, new projects, new technologies, expansion is not really taking place. If corporate India wants to get out of the slump in its sales and profits, out of the uncertainty in its sales and profits, it will need to revive its capital expenditure cycle, which is what it is not doing at the moment. And if the capital expenditure cycle of corporates has come down, so has been the case of households. Capital expenditure by households has been down, and that is reflected by the fact that despite festival sales looking up, the demand for two-wheelers and four-wheelers remains in negative territory in this financial year. Households are not investing in capital goods, And because of that, even the sales of real estate continues to look downwards. Estimates are that the growth in retail loans by which households invest in capital goods has been the slowest in a decade in this financial year. What are the reasons why capex is not looking up? What are the reasons why India Incorporated is not willing to invest in new projects, in expansion of their plants, in setting up new factories, in taking new technologies and introducing new products? What are the reasons why the capex cycle has been slumping? The first fact of the matter is that you invest in capex only when your income has gone up. That is when you think that you have the resources, the need and the confidence to invest. The fact is that real income has fallen in India, both for individuals and for corporates in the last few years. This fall in income got accelerated after demonetization and the impact of GST. It also got accelerated because of rising joblessness. It also got accelerated because corporates are not willing to expand or entrepreneurs are not coming into business because of the difficulties in doing business in India. So the first is real income has fallen and thus capex is not taking place. What we are seeing because of this drop in real income is India at the moment seems to be dangerously headed towards becoming a low income, low expenditure nation, and that is not what growth is all about. Further, if demand goes down, if demand is uncertain and capacity utilization remains low, or rather there's an overhang of unutilized capacity in the economy, then why will new projects come up? And that is what corporates are facing. As per the RBI, the average capacity utilization at the moment in industry is just 74%. That's the kind of unutilized capacity that we are seeing at the moment. And that explains why capex is not taking place. While India is facing languishing demand from the domestic sector, even its exports are languishing. Nothing has happened to make India's exports more competitive such that our exporters sell in growing quantities abroad. Therefore, with exports not taking off, again, capital expenditure related to exports is not taking place. We are witnessing a scene where there is lack of confidence in the consumer to spend and lack of confidence in the producer to invest. That again means capital expenditure cycle is not getting revived. The net result of all this is that there is uncertainty as far as return on investment is concerned, safety on investment is concerned, the risk perception is high, and because of all that, banks also continue to be averse to lending. The real growth in bank loans has been in negative territory, and with this entire scenario, we are in a situation where capital expenditure is not taking place, and thus the long-term boost to corporate fortunes by way of sales and profits continues to be uncertain. The larger picture is that until capital expenditure is not revived by corporates, profit and sales recovery will not really take place, such as that India can reach the 5 trillion economy mark that the Prime Minister has set for the country. The PLI scheme of the government might trigger the capex cycle primarily for exports. But then let's also be clear, the PLI seems to be tailor-made for the big companies, and the capex cycle might get triggered for the big companies. The challenge really lies for capex cycle to be triggered for the MSME sector. Until that doesn't happen, we will not really see an all-round upsurge in corporate profits, an all-round upsurge in sales and profitability. This is Akhilesh Bhargava signing off till we meet again. Namaskar.
Now be the first to know about the latest updates on our new news app. Go on your Android or iOS, search for HW News Network. Download our app, choose the language you prefer to get updates in, and be up to date with the latest news.
If you like this video, please share it, and we would love to hear your comments in the comments section down here. Also, please do like our Facebook page and follow us on Twitter to get minute-to-minute news updates. For more such shows and videos, subscribe to our YouTube channel.